Gold just closed higher by 5.56% in a single week, a violent repricing that shows exactly where the real fear lies. Welcome to the DRS Weekly Global Markets Brief. It's Saturday, August 22nd, 2026. Our theme this week is the fragmentation fortress, a structural shift where institutions abandon the old globalized playbook and barricade their capital inside localized defensive assets. The biggest dislocation right now is the US dollar breaking down through critical support, while US and UK equities quietly grind higher in a fundamental vacuum. Alex, let's start with the international tape, Asia and Europe.
Thanks, Sarah. In Asia, the Hang Seng closed higher by 3.55% at 26,009. The index decisively reclaimed its moving averages, invalidating a lagging death cross where its 50-day at 24,710 sits below its 200-day at 25,700. Beijing's targeted fiscal support and a tech-heavy index rebalance are driving aggressive inflows. Conversely, the Nikkei closed lower by 3.93% to 66,016. The Japanese index broke below its 50-day moving average of 67,358, signaling short-term exhaustion, though it remains above its 200-day at 58,247 to keep its broader golden cross intact, which means Asian capital is rotating out of overextended Tokyo and hunting for value in Hong Kong. Over in Europe, the FTSE 100 edged up 0.62% to 10,817. The UK index is heavily insulated by its commodity-linked mining sector, allowing it to absorb macro shocks. Meanwhile, the DAX posted a weekly loss, closing lower by 1.15% to 26,137, a routine pullback where prices fell despite remaining comfortably above their bullish moving averages. Sarah, back to you.
That rotation out of an exhausted Nikkei and into a revitalized Hang Seng, alongside the FTSE's commodity insulation, perfectly illustrates how quickly capital is seeking new defensive harbors. If international markets are relying on targeted fiscal support and localized resilience to stay afloat, how is Wall Street navigating this fundamental vacuum? Alex, break down the U.S. and cross-asset signal.
Wall Street is quietly grinding higher on pure market structure, Sarah. Looking at U.S. futures, the S&P 500 drifted higher by 0.38% to 73,691, and the NASDAQ 100 drifted higher by 0.30% to 29,388. Without fresh macroeconomic headwinds, equities are moving upward on technical positioning alone. In the bond market, we are flying blind on the 2-year Treasury this week, so we will focus entirely on the long end. The 10-year yield closed higher at 4.69%, indicating that monetary conditions remain restrictive. In the currency space, the U.S. dollar index edged down 0.87% to 98.80. The greenback suffered a severe technical breakdown, collapsing below both its 50-day moving average of 104.48 and its 200-day of 99.18. Completely overriding its historical golden cross. This dollar weakness poured directly into commodities. Gold closed higher by 5.56% to 46.24, reclaiming its moving averages and exposing its recent death cross as a lagging indicator. Crude oil followed suit as prices surged 5.66% to 87. Finally, the VIX plunged to 15.13, reflecting a robust risk-on environment where fear is rapidly leaving the equity market despite elevated bond yields. Sarah, back to you.
Thanks, Alex. The fact that the dollar is breaking down while hard assets explode higher tells us everything about this new regime. When gold closes higher by 5.56% in a vacuum of macro news, it suggests the fragmentation fortress is actively forcing capital out of globalized fiat and into hard reality. Looking ahead to next week's Jackson Hole Symposium and Fed Chair Warsh's speech, all eyes will be on the central bank's inflation tolerance. If policymakers signal a commitment to keeping rates higher for longer, watch for the U.S. dollar index to catch a bid and attempt to reclaim its 200-day moving average at 99.18 as immediate resistance. That's all for this week's episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in and catch you in the next episode.